All right, so are you ready to dive into the Indian stock market?
I am. I am.
Yeah, me too. I'm excited about this one. We're going to look at what's hot, what's not, and hopefully by the end of this deep dive, you'll have a much better picture of whether this market is right for you.
Yeah. Sounds good.
So our sources for this deep dive are a new newsletter from Volatility Coaches of India,
Okay.
which has a ton of really cool data in it, and then also a report on foreign institutional investors.
Ah, interesting combo.
Yeah, so we've got both the granular data and kind of the big picture view of what's going on.
Yeah, I like it.
So let's jump right in.
Let's do it.
Okay, so the Volatility Coaches newsletter gives us a snapshot of some key indices. The Nifty 50, which tracks 50 of the largest Indian companies, is down a bit.
Okay.
But here's where it gets interesting. The Nifty Small Cap 100 and Nifty Mid Cap 150 are actually positive.
Huh. So different parts of the market are moving in different directions.
Yeah, I mean, that's two very different stories, right?
It is. It is. And it suggests that there are different forces at play. You see, the Nifty 50 with those massive companies tends to be more sensitive to global economic conditions,
Okay.
whereas smaller and mid-cap companies, often with a more focused scope, might be riding a wave in specific sectors that are doing really well within India.
Okay, so it's not enough to just look at the overall market direction. We need to kind of zoom in a little bit and see what's happening.
Yeah, absolutely.
Okay, speaking of zooming in, the newsletter mentions the Buffett indicator for India. It's predicting a 6.2% annual return in the coming years.
Oh, the Buffett indicator.
Interesting.
Yeah, so that got me curious.
Yeah.
What is this indicator and should we take it seriously?
Well, the Buffett indicator is named after, you guessed it, Warren Buffett.
Of course.
And it essentially compares a country's stock market size to its entire economy, or GDP.
Oh.
You can think of it like you're baking a cake. The cake is the economy, and the frosting is the stock market.
Okay, I like where this is going. Right, if there's way too much frosting, it might be a sign that the market, is a little bit overvalued.
Interesting. Okay, so for India, this 6.2% projection,
Yeah.
it's based on a few things, right?
Right, we're looking at a combination of factors. First off, a decent economic growth rate of 6.86%, plus a 1.5% dividend yield, which is basically a little bonus for investors.
Nice.
But then there's also this factor called valuation reverse to the mean at negative 2.17%.
Okay, reverse to the mean. That sounds kind of mystical.
It's not magic,
Okay.
but it does look at historical patterns. You know, when you flip a coin,
Yeah.
you might get a streak of heads, but over time, things tend to balance out to roughly 50-50 heads and tails.
Right.
The market's similar. Sometimes it gets a little too optimistic, sometimes a little too pessimistic.
Yeah.
But over time, it tends to settle back to a more average valuation.
Okay.
So in this case, the indicator is considering a potential pullback because it suggests the market might be a tad overvalued right now.
Okay, so for someone like me who's maybe thinking about getting into the Indian market,
Yeah.
what does this 6.2% projection really tell me? Is it a green light to just go all in?
Not necessarily. It's important to remember that the Buffett indicator is just one piece of the puzzle.
Right.
It gives us a sense of whether the overall market seems reasonably priced,
Okay.
but it doesn't tell us about specific companies or industries
Right.
or any surprises that might pop up. Think of it as more like a compass, not a GPS. It points you in a general direction, but you still need to do your own map reading.
Okay, it's a starting point.
Exactly.
Got it. Okay, so we've got a feel for the overall market. Now let's bring in the heavy hitters. The foreign institutional investors, or FIIs.
Okay.
Our report says they're currently selling more than they're buying in the Indian market.
Interesting.
So does that mean they're losing faith in India's growth?
That's a great question, and it's not a simple yes or no answer. You see, FIIs are like whales in the ocean. Their decisions are based on a complex interplay of factors. Everything from global economic trends and interest rates to political stability within India and even government regulations.
So they're looking at India as part of a bigger picture.
Exactly. And right now, several things could be making them a bit cautious.
Okay, like what?
For example, rising interest rates in developed economies are making those markets more appealing. Plus, there's a lot of uncertainty globally, from geopolitical tensions to slowing growth in some major economies.
Okay.
And that makes FIIs less willing to take big risks in emerging markets.
So it's not necessarily that they don't like India anymore, they're just being more cautious overall.
Right. It's about managing risk in a volatile global environment.
Okay, that makes sense. Now, let's get into some specific data points from the Volatility Coach's newsletter.
All right.
The Nifty 13 EMA, which I understand is a technical indicator, is trending downwards. What does that tell us?
Think of the 13 EMA as a short-term mood ring for the market. It tracks the average price over the last 13 trading days, and a downward trend suggests that selling pressure has been stronger than buying pressure recently. It's a little blip on the radar that tells us things might be cooling off in the short term, but it doesn't necessarily mean the long-term trend is shifting.
Okay, so not a reason to panic, but something to keep an eye on.
Exactly.
What about the VIX, the so-called fear index? It's dipped slightly, so does that mean things are calming down?
Well, the VIX measures how much volatility investors expect over the next month. A lower VIX usually means less fear.
Okay.
But sometimes it could be a sign of complacency. It's like when everything seems too quiet right before a storm hits. We need to look at other indicators to see if this lower VIX is a genuine sign of stability or just a temporary lull.
So a low VIX isn't always a good sign.
Right. It's all about context.
Got it. Now, there's a section in the newsletter called Notes and Observations, and it gets pretty intense. They say below 23,000 Nifty level, convert all debt to equity. That's a bold statement. What's the thinking there?
What's fascinating here is their unwavering belief in India's long-term potential.
Okay.
They're essentially saying that if the Nifty 50 drops below 23,000, it's such a good buying opportunity that you should shift your assets from things like bonds, debt, into stocks, equity.
So they're saying if the market dips, double down.
In a way, yes, but then they get even bolder.
Okay, let's hear it.
They say below 22,000 Nifty levels, buy more equity, even convert gold and FD to equity.
Hold on, FD? What's FD?
Ah, good catch. FD stands for fixed deposits, which are super popular in India.
Okay.
They're like super safe savings accounts with guaranteed returns. So they're suggesting that if the market falls to 22,000, it's time to buy even more stocks and even consider selling your gold and cashing out those FDs to get in on the action.
Wow, that's a big bet on India.
It is. It's a high-risk, high-reward strategy.
Yeah. What are the downsides of going all in like that?
Well, the main downside is that if the market keeps dropping, you could lose a lot of money. This kind of advice is really only for investors with a high-risk tolerance and a long-term outlook.
Yeah, makes sense. Okay, so this brings us to the newsletter's final thought, positive always in the long term. So it seems like even though there's some short-term uncertainty, they're pretty optimistic about India's market in the long run.
You're picking up on a key theme here. A lot of investors who focus on emerging markets like India believe that while there will always be some volatility, in the long run, the strong economic fundamentals and demographic trends will win out.
Okay.
They're looking past the daily ups and downs and betting on the bigger picture.
It's a marathon, not a sprint.
Exactly.
Okay, so we've laid the groundwork, we've explored some crucial data, and we've gotten a sense of the big picture.
Yeah.
But I think we've only just scratched the surface.
Definitely.
In the next part of our deep dive, we'll roll up our sleeves and dig into specific sectors.
Oh yeah, let's get granular.
Yeah, those hidden gems that might be flying under the radar.
Sounds good, I'm ready.
Stay tuned.
Looking forward to it.
Welcome back. So we talked big picture. Now let's get into specific sectors.
Okay.
Because as we saw, India's market is not moving in one direction. Some areas are hotter than others.
That's right. Understanding those sector-specific trends is key for making informed investment decisions.
So let's open up the Volatility Coach's newsletter again. They've got this table with data on different sectors.
Okay.
What jumps out at you?
Well, first off, remember how we saw the Nifty Midcap 100 and Nifty Small Cap 100 doing pretty well? That suggests that mid-sized and smaller companies are holding their own, even with the Nifty 50 being a bit sluggish.
Right. So maybe the real action is happening outside of those giant companies.
Potentially.
But even within these mid and small cap indices, are there certain sectors that are really taking off?
The newsletter highlights a few key areas: banking, finance, IT, and pharma. These have traditionally been strong sectors in the Indian market. And it looks like that trend is continuing.
So even within a positive trend, there's another layer of selection going on. Investors are saying, okay, mid and small caps are looking good, but let's focus on these specific areas.
Exactly. It's like finding the best neighborhoods within a booming city.
I like that analogy. So let's say I'm interested in one of these sectors. What questions should I be asking myself to really understand the opportunity?
I'd start by looking at the long-term growth drivers. What's fueling the demand in this sector?
Okay.
Is it something temporary, or is there a fundamental shift happening that will sustain this momentum for years to come?
Right. So like in IT, is it just a temporary boost for remote work trends, or is India becoming a major tech hub for the long term?
Exactly. You want to see that long-term potential. Then consider the impact of government policies and regulations. Are they supporting this sector or creating hurdles?
That makes sense. And what about competition?
Competition is key. You want to see healthy competition driving innovation, not a stagnant market dominated by a few big players.
Right. So those are some good things to look at. Okay, now let's talk about risk. We talked about the VIX, which measures overall market volatility.
Right.
But the newsletter also gives us a volatility measure for each sector. Why is that important?
That's a great point. Even if the overall market seems calm, certain sectors might be experiencing much wilder price swings.
Okay.
For example, the newsletter shows that the Nifty Midcap Select, which has a price-to-earnings ratio of 42.19, also has a higher beta.
Wait, price to earnings ratio, beta,
Yeah.
remind me what those are again?
Sure, the price to earnings ratio, or PE, tells you how much investors are willing to pay for every rupee of a company's earnings. A higher PE suggests investors are optimistic about future growth. Beta, on the other hand, measures how much a stock's price tends to move compared to the overall market.
Okay, so a beta of 1 means it moves in sync with the market. Higher than 1 means more volatile, and lower than 1 means less volatile.
Exactly. So in this case, the Nifty Midcap Select's higher beta tells us it's likely to experience bigger price swings than the broader market, even if the overall market is relatively stable.
So even in a seemingly calm sea, certain sectors can be like speedboats zipping around.
You got it.
Makes diversification even more important.
Absolutely. Don't put all your eggs in one basket, as the saying goes. By spreading your investments across different sectors, you can smooth out the ride and reduce the impact of any surprises.
Diversification, it's the investor's best friend. Okay, before we wrap up this sector deep dive, anything else in the data that stands out to you?
Yes, I'd like to point out the dividend yields for different indices. You'll notice that some sectors, like the Nifty Midcap 50 and Nifty Smallcap 100, offer higher dividend yields compared to the Nifty 50.
Oh, right. Dividend yield, that's like getting a little bonus payment for owning a stock.
Exactly. So for investors looking for some steady income from their investments, those higher dividend yields might be appealing, even if the overall growth potential of those sectors is a bit lower.
Interesting. So it depends on your goals as an investor.
Exactly.
Okay, so we've covered the market overview, we've dug into specific sectors.
Yeah.
Now, what's next in our exploration of the Indian market?
Well, we've talked a lot about numbers and data, but numbers only tell part of the story. To really understand where the Indian market is headed, we need to zoom out even further and look at the bigger picture, the macroeconomic landscape.
You mean things like the overall economy, government policies, and global events that could impact India?
Precisely. It's like understanding the weather patterns that influence the entire ocean, not just the waves on the surface.
Okay, got it.
So in the next part of our deep dive, we'll explore some of those macroeconomic factors that are shaping India's growth trajectory and what they mean for investors.
Sounds good. I'm ready for that.
Stay tuned.
Welcome back. So we've looked at the market overview and zoomed in on some sectors, but now it's time to go big picture, like really big picture, the macroeconomic landscape of India.
Exactly. Think of it like we've been looking at the waves on the surface.
Yeah.
But now we need to understand the currents that move the entire ocean.
Gotcha. So if I'm thinking about investing in India, what are some of the big economic factors I should be paying attention to?
Well, the first thing to look at is India's GDP growth rate. That's like the speedometer of the economy, telling us how fast things are moving. A strong GDP growth usually means companies are making more money, and that can push stock prices up.
Okay. And how's India's GDP growth looking these days? Are we talking speedboat or sailboat?
India's actually been one of the fastest growing major economies in the world for a while now.
Wow.
There might be some bumps in the road because of the global issues, but the long-term growth story looks pretty solid, driven by a young population, increasing urbanization, and government initiatives focused on boosting infrastructure and manufacturing.
That sounds really positive.
It is.
But I imagine inflation is a concern, like it is everywhere else right now. How's India dealing with that?
Inflation is definitely something to keep an eye on. High inflation can eat away at people's purchasing power.
Right?
And it can squeeze company profits, which could impact their stock valuations.
Makes sense.
The Reserve Bank of India has been working to control inflation, but it's definitely an ongoing challenge.
So it's like walking a tightrope. You want to keep the economy growing, but not so fast that it triggers crazy inflation.
Exactly. Finding their balance is key. Another factor to consider is the government's fiscal policy, meaning how it's spending money and managing its debt.
Okay.
Government investments in things like infrastructure and social programs can help stimulate the economy.
Yeah.
But if spending gets out of control, it can lead to higher debt levels, which can drag things down in the long run.
So it's like personal finances, but on a much larger scale.
That's a great analogy. And then you've got other macroeconomic forces that come into play, like global commodity prices, especially oil. Since India imports a lot of oil, changes in oil prices can really impact its economy.
So even if things are going well, internally, external factors can still cause problems.
For sure. And we can't forget about geopolitical events. Things like conflicts or political instability in other parts of the world can create uncertainty and make investors nervous, which can impact markets everywhere.
Right. So even though we're focusing on India,
Yeah,
we can't ignore what's happening globally.
absolutely. It's all connected. Now, let's talk about something that's often a big question mark for investors.
Okay, what's that?
Political stability. How does that factor into the equation?
Well, I imagine it's pretty important. If a country is going through a lot of political turmoil,
Yeah.
it's probably not the best place to put your money.
You're right. Political stability is crucial for businesses to thrive and for investors to feel confident. Policy flip-flops or political instability can create a lot of uncertainty and scare away investment.
So what should investors be looking for in terms of India's political situation?
Well, India has a long history of democratic institutions and a relatively stable political system.
Okay.
But it's always wise to stay informed about things like upcoming elections, potential policy changes, and any geopolitical tensions that might be brewing.
Do your research.
Always.
Okay, so let's connect this back to the sources we've been looking at. Does any of this macroeconomic context help us understand what we saw in the Volatility Coach's newsletter and the FEI report?
I think so. The Volatility Coach's long-term optimism about India seems to align with the idea that the country has strong economic fundamentals and a lot of growth potential.
Right, they're looking past the short-term stuff.
Exactly. And their bold recommendation to shift from debt to equity if the Nifty falls below certain levels reflects their strong belief in that long-term growth story.
Of course, that kind of strategy comes with its own risks. It's not for everyone.
Absolutely. It all comes back to individual risk tolerance and investment goals.
Right, investing is not one size fits all. Okay, so as we wrap up our deep dive into the Indian market, I want to leave our listeners with a final thought. Given everything we've talked about, the IDA, the expert opinions, the big picture, where do you see the Indian market heading in the next year? What are the key factors you'll be watching closely?
That's the million-dollar question. It's tough to predict the future with any certainty.
For sure.
But based on what we've discussed, I think the Indian market offers a compelling opportunity for long-term investors. There might be some ups and downs along the way,
Right.
but the overall direction seems positive, driven by strong economic fundamentals and a dynamic entrepreneurial spirit.
I agree, but as you said, it's important to stay informed, keep an eye on those macroeconomic trends, and be ready to adjust your strategy as needed.
For sure, investing is a journey, not a destination.
Well said. And on that note, this concludes our deep dive into the Indian stock market. We hope you've learned some valuable insights and feel empowered to continue your own exploration.
Happy investing, everyone.
Thanks for joining us.